Good morning. Welcome to Stock Market Today for Friday, June 12th, 2020. This is your host, Dan Russo, the Chief Market Strategist at Chaikin Analytics. You can find me on Twitter at DanRusso_CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to chaikinanalytics.com/today. Sign up for a free email where I get a lot of the content for this show, as well as give you daily stock ideas to consider. That hits your inbox every trading day before the market opens. So U.S. equities got hammered yesterday. My note says closed down meaningfully. They got hammered. That completed its first 3-day decline since early March, as COVID-19 infections and hospitalizations have moved higher in a number of states over the past couple of days. Treasuries were mixed, with the long end stronger and the curve flattening. The dollar was weaker on the yen cross, stronger against the euro. Gold finished up 1.1%. Crude oil was down 8.2%, but did finish off its worst levels of the day. A little bit of a rebound here this morning, with S&P futures up about 2% as I hit the desk. Asian markets were mostly lower overnight. South Korea and Australia, notable decliners. European markets are seeing good gains after a soft start. Treasuries are weaker across the curve. The dollar stronger against the yen, weaker on the euro. Gold up 20 bips, WTI crude up 70 basis points to get us going on a Friday morning after a Thursday session that's produced this ugly black candle that left this island reversal on the chart of the S&P 500. An island reversal is a gap higher, followed shortly thereafter by a gap lower, leaving what looks like islands in the stream on the chart. Now, the pullback, in fairness, I've been giving you the heads up on this all week, saying wouldn't be surprised to see a pullback here to 3,000, 3,100. We want to see that level hold. If it doesn't, 2850 to 2950 become important to keep the structure of the uptrend in place since the March 23rd lows. Now, we are less overbought. Chaikin money flow is bullish. So for all intents and purposes, I think the February highs are still in play. Took a bit of a blow yesterday. I mean, that was a powerful gap. To be perfectly honest, some hints of this, right? Couple days of weakness followed by a gap. Couple days of weakness followed by a gap. In this case, the gap was down through the 50-day moving average. We did close below the 200-day yesterday, so something to keep in mind as we identify that support level. I'm not saying it's playing out exactly the same way, but I'm saying that all week we've been saying we were overbought. All week we've been saying here are the levels we want to see to the downside hold. I think you have to have your risk management process firmly in place at all times, but it's easy to become complacent and get a little lax in your work sometimes. Make sure your risk management process is in place. There will be some choppiness along the way. I don't think we're going to the February highs in a straight line. So just, there'll be opportunities there. What are we writing about the note today? Well, stocks see large declines as COVID cases increase in many states. The pullback is testing that first support zone for SPY. We just looked at the S&P 500. These are the bullets that I pull from my notes. And the emerging signs of increased risk appetite are now testing important levels. And I'll show you one that's really important in my opinion. We're watching relative strength in the Russell 2000, right? Because that's a big part of the rotation trade as well as risk appetite. As I said, futures do point to a higher open today. No way to sugarcoat it, folks. I told you it was a disaster. I told you it was downright ugly. Dow losing nearly 7%, 1 bull to 11 bears there. Now look at the swings in some of these ratios after a big day like yesterday. S&P 500 down 5.75%, 67, 152 bulls to bears. NASDAQ was an outperformer. It was down less than 5%. So that is an outperformer. Small caps absolutely decimated, down 7.5%. Dealing a large blow to its ratio. Bonds, flight to safety sends prices higher, yields lower. According to the Chaikin Power Bar, large cap stocks are more bearish than small cap stocks, and the major markets across the board are mixed. In light of that, we're going to search for opportunities. Pullbacks in leading stocks entice me until they don't. So NVIDIA is actually a name that I own, and I think it's setting up again. Bullish Chaikin power gauge rating, strong trend above the rising long-term trend line. Semiconductors are a strong industry group right now from a power bar perspective. I think that you have this kind of setup here where investors are gravitating back towards the growth areas of the market. So you do have some relative strength behind a trade in NVIDIA. Chaikin money flow, bullish. Overbought, oversold indicator moving higher from an oversold position. That entices me. It doesn't entice me enough to say push in all your chips, right? I think you need to manage your position size. Given the uptick in volatility, I think you need to manage risk, but this is an interesting name because if the market holds support and begins to move higher, I think NVIDIA is going to be a name that leads the charge. But if we break and move lower, you've set your stop, right? You know where you're getting out before we get in. So I still think the Feb highs are in play. And if the Feb highs are in play, I think it's likely growth that takes us there. NVIDIA goes along for that ride. So it looks compelling to me as a long idea while acknowledging we may not be right. So we set our stop, right? Hopefully one of the things you've taken away from me over the years of doing this show is setting your stop. You should know where you're getting out before you get in. And I don't care if you're trading NVIDIA. I don't care if you're trading Apple. I don't care if you're trading bankrupt garbage companies. You want to play the technical game. You want to buy Hertz because it's going up. That's great. I don't love it. I don't condone it. But if that's what you want to do, set your stop. This way you don't get caught holding the bag in a big downdraft like yesterday. Let's look at our sector tracker now. Movement of the major sectors over the last 5 days. Quite a turn of events. This chart spent most of the week all green. Now we're all red. With what's interesting is the rotation trade has moved to the bottom quickly, right? Industrials, energy, materials, and financials are your rotation trade, and they were decimated yesterday. So we have to see how they respond with the market now testing support, right? Do they muster a charge, or was it just a replay of 4Q19 where the rotation trade tried to come on the back of the China trade deal only to fade at the start of the year? I think we are at an inflection point right now. Right? Does the market hold 3,000? If the market holds 3,000, do these reflation asset classes reassert? Right? 2 down days and these things fell to the bottom of the list. That's crazy. Tech and comms back at the top of the list. Healthcare middle of the road. Utilities are one I'm watching closely because I think utilities are sneakily starting to move up in relative strength. And if they begin to outperform the market, that could be a sign of further weakness in the equity market. Our industry in focus today, mining services, complete train wreck over the past 6 months, down about 20.5% relative. Power bar ratio strong, 5-4 bulls to bears, middle of the road, 11 of 21 subsectors having moved down 3 slots over the past week. Suncoke Energy, SXC, Schnitzer Steel, SCHN, and Steel Dynamics are the bullish names you want to pay attention to. But I can't really get excited here just yet, other than gold miners. I like gold miners. Hard for me to get excited here, just given the relative strength. We're not there yet, right? And here's what I was talking about. Remember the reflation trade? And I said this echoes 4Q. Take a look at October through December where the relative strength steadily gets better before then rolling over. Very similar dynamic at play to a lot of the reflation assets out there. Even the IWM, right? Take a look at the IWM. If you get my note today, I featured the IWM. The IWM is slowly getting better on a relative basis, tried to tick positive, and then, took a major turn for the worse yesterday. So it's hard for me to get excited about XME when it's still an underperformer. I want to warm to it, but I'm not there yet. Worth watching, though. Taking a look at what's trending now. Yesterday's S&P 500 movers and shakers are gainers and losers. And that's not an error. There was only one stock in the S&P 500 that was up yesterday, and it was Kroger. Interestingly, if you drill down on stock performance yesterday, the stay-at-home stocks actually had decent days. Zoom was higher, DocuSign was higher, Peloton massively outperformed. We're starting to get more and more news about an increase in COVID-19 cases in some states, cases as well as hospitalizations. I actually read an article this morning where Houston was considering a second quarantine. I don't necessarily think the population or investors have an appetite for a second quarantine. But I don't think it's a zero probability event. Just something to be aware of. I'm not saying it's going to happen. What do I know about what governors are thinking about a quarantine other than what I'm told on TV? But just as things are starting to reopen, we're starting to see an uptick in cases. So just, I think it's something we need to be aware of, something we need to be paying very, very close attention to. Loser side of the board, Norwegian Cruise Line down 16.5%. It's one of your beaten down stocks that people want to trade. Just have your risk management. Boeing, some news that they told Spirit Aerospace Systems to kind of pull back on producing some parts on the 737 MAX. Investors didn't like that, so they took 16% out of Boeing. Oxy was initiated at MKM with a neutral rating. I think the stocks had a big run. United Airlines, no real news yesterday, downgraded today. ADS down, nothing company specific there. So small caps are in a key spot, both absolute and relative. Here's that IWM pullback, right? Gap down, resistance, gap up, right? 135 resistance, solid support or key level in small caps that needs to be watched. Yesterday's pullback broke this uptrend for the RSI. Now, if you're bullish small caps, if you're bullish the reflation trade, you want to see a quick rebound, close this gap without RSI becoming going back into bearish ranges. On a relative basis, you want to see this level hold, right, against the S&P 500. Otherwise, you'd have a false breakout here. So there are a lot of inflection points in the market currently. I think it's really interesting, and how these inflection points resolve are going to be really important going forward, right? Is this just a pullback? Does S&P hold, right? Does IWM reassert to the upside, right? Right now, the trend is still up, but we have to reassert to the upside, right? What about semis? Potential for a false breakout here. Right? A lot of these charts, a lot of inflection points. What's interesting to me about semis is that this rally did not produce an overbought condition on RSI. Tried to punch through, faded. Tried to punch through, faded hard. Potential false breakout. If you look at the Qs, it actually looks similar. Relative basis consolidation, trying to break top side. But I think this is something that we need to watch semis here closely, really closely. And I think that if they continue lower from here, we have a problem. That false breakout is now on watch. And then finally, copper to gold, right? One of the big ones that I talk about for global growth. If you're in the rotation camp, this is one you're paying close attention to, right? Here's that fourth quarter of last year. Tried to rally, got back to the 200, faded. Here's this year. Trying to rally, got back to those 2016 lows, starting to fade, question mark. If this starts to pull back, I would expect to see a breakdown in treasury yields, rally in bond prices. The Fed has explicitly said that they don't see negative rates as an option. That does not mean that the market can't take them there. Most certainly can. I'd be watching the front end of the curve first, the 2s and the 5s. We're looking at the 10 here. But I hope everybody has a great weekend. Take us for a test drive. I'll be back on Monday.